Welcome to another homemade video. Now, I've been asked a lot in these volatile weeks about how I think about investments and markets. So I thought it might be worth sharing with you the 5 concepts that really have stuck with me over a number of years. Because investment strategies need to be designed to cope with both bull and bear markets, allowing you to stay invested over the cycle, benefiting from the powers of compounding returns and capturing the risk premia offered by equities and credit over the longer term. That is effectively the potential for higher returns over the safest form of investments. Now, not surprisingly, you need to have a disciplined and systematic approach. Avoiding that worst 4-letter word, at least from an investor's perspective, is critical, namely hope. So what are these 5 concepts? Well, the first one is understanding your liabilities. Whether you are an institutional investor or an individual, knowing what obligations you have and when they're likely to come up is critical to a successful investment approach. The last thing you want to do is find that you're surprised by something that you should have known about a commitment and you have to liquidate assets potentially at the worst possible time. So again, understanding that liability profile is critical. Now, the second point is avoiding taking unrewarded risks. Now, we all know that risk and reward go hand in hand, but you need to minimize some risks that offer very little or no return and actually can be avoided. Now, this can be simply having a diversified portfolio, minimizing the idiosyncratic risks such as single name exposures or large position sizes in order to reduce your risk profile. In other words, not putting all your eggs in one basket. And by doing something as simple as this, you can reduce your risk profile while not really giving up anything on the return front. Now that takes us to our third point, is understanding the risks that you really do want to take on board. Remember that if an investment is offering a very high return, the likelihood is that the risk associated with that is also likely to be very high as well. So you really must understand what it is that you want to be taking on board and making sure that the return that you're likely or you expect to get from that is commensurate with that risk that you're taking on. Now that leads to our fourth point, which is really know the facts and don't live in hope. Now, just because the value of an asset plunges doesn't necessarily mean that it's a bargain. For example, if equity markets fall by about 30% and yet expectations for earnings going forward is down 40%, well, on that simple PE valuation metric, the market has actually become more expensive, not cheaper. Equally, when markets move up very quickly, again, if their fundamental prospects are getting better, it doesn't necessarily mean that it's a bad investment. So in other words, know the facts and understand the dynamics of the market. And that leads us to our fifth and perhaps most important one, which is don't panic. The greatest asset actually of an investor is patience. And that's something that we can see in terms of big moves up in markets, or actually when markets fall precipitously. Not panicking, remaining calm, not becoming pro-cyclical and just doing what everybody else does is actually very profitable over the long run. Make sure that you can capitalize on some of these big moves, but make sure you understand why these moves are happening and really understand the fundamental drivers behind the markets. And remember, really only act if you feel that you've got a high conviction level and that you're convinced about the fundamentals, the way they're likely to pan out. So again, don't act with haste and certainly don't act in hope. Now, I actually hope that you find this quite useful. Please do leave any comments that you have. And remember, you can read all our investment and economic publications, as always, on zurich.com/MSME.